Welcome back to my Canadian HELOC Dividend Investing channel. Today I'm going to go over my passive dividend income portfolio where I earn an average of $32,000 annually of passive income. Let's get started. If you see my last video, you see that in the last 2 months when I got started with this HELOC leverage passive income strategy that I implemented for myself, the account made over $66,000. From today's market action, the account have grown just over $3,000. So the profit is sitting at $68,588. And today's video, I'm going to go over what is in my portfolio, how I selected them, and let's get to it. So the first thing you need to do is, what I did is, I went and tried to mirror an ETF, a dividend aristocrat ETF. So basically, if you were going to buy an ETF, it would have all these funds or shares in it already. So instead of paying the management fee, I'd rather hold them myself. So the one that I picked to mirror is the iShare CDZ, Canadian Dividend Aristocrat ETF. So you go to their website, you search for a CDF, and then you scroll down to their holdings, the top 10 holdings, and then you could download their Excel file. So you click on download, then I already have it downloaded, so I'm going to open it up. So what I did was I looked at the list. I did my own research on which one I want to buy, and I already highlighted the ones that I did bought for my portfolio. Because as I said in my last video, in order for the leverage HELOC strategy to work, the main benefit is to be able to write off the interest, the HELOC interest during tax time. And in order to do that, your investment that you buy must have the expectation of generating income, right? So you want to avoid REITs because their dividend or distribution is sometimes most of the time has ROC, which is return of capital, which you can't claim the interest for those type of income that they pay to you. So I selected the ones mainly from this list that are highlighted in yellow. You can see that the list has a lot of pipelines. They have insurance. Got some insurance, and I got some telecom, and a lot of them are also utilities. So these are the main ones that you do want to look at. Again, you could do your own research and select the ones that fits your needs. Okay, coming back to my spreadsheets, I'm going to show you how well the portfolio is doing. Going to my holdings. So as you can see, these are all the shares that I'm holding. How many shares I'm holding for each position, each stock. What is my average cost that I paid for it, average book value and average cost. What is the market value right now? And then the difference between market value and cost is my capital gain. So this is where My capital gains is $62,602. And then you have your dividend. So in the last 2 months, I already received, as I said in my last video, just under 6,000 in dividends. And then when you add your capital gains and dividend, you get your profit, and that's where I get up to 68,588 profit as of today, May 10th. Okay, and you can see the portfolio has done pretty well. I only have like one lagger that is in the red, which is my Algonquin Power. Right now, the renewable space is in a decline at the moment. So I bought some at around $22, and then I averaged down while it came down. So my average cost now is at $20.69. Still below what it's currently going at $19.20, but I believe in this. They were in the latest annual report, actually last quarter report, they have already raised their dividend by 10%. So that's a good news, because this is a dividend portfolio. So I'm more interested in the dividend than the capital gain at the moment, because I'm planning to hold these shares for the long term, right? As I said in my last video, we're looking at a 10 plus years investing horizon. So, and I'm going to explain why I'm like 45% in telecom, right? And it's because of my Shaw holding. So my Shaw holding was never this big, right? It's I think it's, let me see. Oh, I don't have the weight. Yeah, it's 27% of my portfolio. This used to be around 5 or 4% of my portfolio, but I doubled down on it when Rogers had an offer to buy Shaw cables for around the $26 billion takeover. So that works out to be $40.50 a share, right? And when that news broke, the next day, the Shaw price only went up to $33 to $34, around that range. It traded in that range, and that's still around $7 below the offer price. And you know what? I believe the deal will go through. I believe Rogers do want this to go through, and at that time, I think they would be willing to divest Freedom Mobile, which is basically the hurdle, I believe, because that's the only overlap between Shaw and Rogers is Freedom Mobile, right? And what got me more bullish is just a couple of weeks ago, it was reported that Bell was also looking to buy Shaw Cable, and what came out of that was there was a hell and water clause that Bell didn't want. Basically, I didn't know what it meant, so I read up on it, and it basically meant that the buyer needs to do whatever it takes to fulfill the regulatory requirement for the takeover to take place. So what that means is, if the regulator says, yeah, you could take over Shaw, but you need to sell off Freedom, or you need to sell off some of your 5G spectrums, Bell did not want to take that risk. So they back out of that deal, and it looks like Rogers was willing to take that risk. And so that's why Rogers is now in that takeover position now. And again, I believe Rogers would be willing to divest Freedom Mobile if it meant to close this deal. So I'm pretty confident. So that's why I went, as you can see, I went all in with Shaw Cable, right? And you can see the price appreciated to $36 now. and it started to climb. As I said, prior to the Bell news, it was sitting around $33, $34. Since the Bell news came out, you can see that the stock price has gone up to $36. And the good news is we are being paid to wait, right? Because Shaw is still continuing to pay their monthly dividend while this takeover is being played out, right? So I'm expecting to still receive close to a year of Shaw dividends on a monthly basis. So that's the upside here. Okay, and yeah, this is pretty much it. As you can see, majority of my holdings are in the positive side. Great West has done really well. I'm up 21% on Great West. The only sad part was I didn't invest my usual amount. Only around the March timeframe, what I did was I was putting in 7,500 each day, right? And I put it on day one. The next day, the price has already started to climb. I thought it's going to come back down, and it never did. So that's why I was stuck on this position while I loaded up on my other position, and I dumped more into my telecoms, into my Shaw, into my Enbridge, and into my Bell Canada. And you can see from my portfolio, I'm heavy on telecom, like Bell Canada. I'm on 13.5%, and again, I doubled my position in Bell. Again, when they raised their dividend, and their dividend is attractive at over 6% at that time. And Enbridge, as I said, Enbridge I think is the king of the Arva pipeline. Their dividend at that time was in the mid 7%, and that was a screen buy for myself at that time. So I doubled down on my Enbridge holdings. Okay, and I also, I also took some chance on some growth dividend payers because Canadian National Railway, their dividend's not that high. I believe it was 1.8% dividend when I bought it. When it came back down with the takeover of Kansas Rail, it dropped down, so I bought a little bit more. So I'm good there. And Custarge is another growth dividend play. Their dividend is under 1%, I believe. So I'm buying it for the growth. Okay, that's it for this week. And again, for my next video, I'm going to go over some of my weekly trades and the other second half of the strategy, which is what do I do with these dividends, right? Do I reinvest it, or do I buy different shares, or what do I do? So I'm going to talk about that in the next video, where it fulfills one of my second reason why I did this strategy, right, is to help me fill in the gaps that I have with my TSFA account, because again, I wasn't putting too much of my money into my TSFA while I was paying down my mortgage. So now, since I'm mortgage free, now is the best time for me to make sure I ramp up my TSFA back to the max, and leveraging all these dividends that I'm getting paid. It shouldn't take more than a couple of years, or maybe just 2 years, for me to max out my TSFA account. Okay, see you in the next one.